when you have an inefficiency, just because it closes that inefficiency in, that's not balanced. It's not a balanced void, okay? It's just repriced to the inefficiency. Those levels of the high and low that makes that inefficiency will still be referred to by the algorithm. You see proof of it just by extending it through into the last hour of trading. Now, at 3:11 to 3:12 to 3:13 New York local time, which would be 5:11, 5:12, and 5:13 on New York time on TradingView's chart, 1 minute. There's a fair value gap there. And you see me drawing that in the little light blue. I took all the other fair value gaps because it would have been too much, because I knew I was going to put a watermark on it, because I know any type of trade like that, everybody's going to put that on their Instagram and say, join my signal service. Look, I can do that. They're fucking assholes. So I hate the fact that I got to do this, because I don't like seeing it clutter up the chart. But if I don't do it, everybody takes my shit and pretends it's theirs, because nobody's pushing buttons and having this much precision. So if you take that 1 minute fair value gap, notice how it just bangs the bottom of it. It does not need to come outside of that 1 minute fair value gap, because we've already touched the low end of the 15 and the 60-minute fair value gap. Once, you're probably saying, what the hell does that have to do with the funny cars and the racing, right? If you know the market's likely to go 38.64, and you know that the likelihood is everybody's going to be squeezed out of their short positions, because the algorithm is going to start repricing higher, 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 spooling towards those buy-side liquidity pools that I've outlined on the chart at 54, if my memory serves incorrect, and then up at 64. Okay, so the initial buy-side liquidity, that was the first draw. And what I'm waiting for is, I want to see speed. You'll see me say in there, I type it out and say, okay, you're going to start seeing large range candles and the speed. Study the speed. You're going to hear me talk about this in the live streams. You're looking for that. That is a signature. What does that mean? It's something that you should be seeing in price. If it's not doing that, you're probably offside, or it's going to consolidate longer. And depending upon the time of day, if you're going into lunch, you want to cut bait. Don't trade. But ICT, we watched you trade in New York. That's me. I'm trading outside of what I've already been willing to share to you. I have other tricks and shit. I got all kinds of stuff. I got weapons you ain't never seen before, and I'm not going to share them all. I'm sorry. You can't have all my tech. I'm sorry. You're not entitled to it. I'm not teaching everything I know. But what I am teaching, what I've already taught, is plenty. So if you're expecting speed in the direction of that 38.64 level, what would you want to see? A real quick sudden move up, just like that, right? Now, for the gentlemen out here to have, and maybe some of you ladies too that are hot rodders, if you have a fast car, and maybe you just got your license recently and you took your dad's car out and you want to burn some rubber, knowing damn well you shouldn't be doing it. But when you sit there and you neutral drop your car, I'm not saying that's a good thing, but some people do it, you burn out and you make a skid mark as the car takes off real quick, okay? You want to see that in price, that burnout, that sudden run. ProCharge Mopar knows exactly what I'm talking about right now. He's already smiling because he's now getting it. That runaway, real quick move, when you're expecting speed to come into the marketplace, that displacement, you want to see it stay open. You do not want to see it come back down in. When you see that, that is a breakaway gap. When we had markets that were not 24 hours, okay, like Forex is 24 hours, and stock indices are not 24 hours, but there's a small window of time where 1 hour it's not trading. But you have a gap opening. That gap opening sometimes is useful. But when we didn't have electronic trading, there was always gap openings. You had overnight gap risk is what it was. Gap risk is always an issue. You didn't know where your currency futures were going to open up. You didn't know, where the shit was going to open up unless you were monitoring overnight, on the Globex, what was going on. And Globex is like the overnight session. So I'm trying to teach you to anticipate when you're expecting a market move to go a one direction, higher or lower, based on your bias. The narrative was, I left you in the morning session, 38.64, note that relatively equal high because that's where we're heading. 3 o'clock hour starts. We are finding real support at fair value gap discount lows, and we create a fair value gap on the 1 minute chart. 11 minutes, 12 minutes, and 13 minutes, respectively, on a 1 minute chart on ES. That fair value gap is drawn out for you in the recording. It's a little light blue one. I move my stop up just below the low of the 311 to 313 fair value gap. I'm just below that, one tick. And the whole time I'm recording this, I'm thinking to myself, they're going to shit themselves when they see this. And to prove it, I went in and I bought it again when it went down and touched the bottom of the fair value gap. Why didn't it go outside of that? That's what you're wondering, right? Why didn't it go outside that? Because it had already tapped the low of the fair value gap on the hourly, the 15, and the 1 minute fair value gap. It had already touched it twice perfectly. And we were running short on time. We were running down the clock until 4 o'clock. Yes, it trades a little bit past that. That's not my point. The volume that's going to come in on market on close orders is 3:40 to 4 o'clock. That little window right there. Okay. Days that close with liquidity pools that have not been breached or engaged yet, you'll find that that little segment of time is a sweet spot for a model all in of itself. Who wouldn't want 20 handles? I pulled it out like it was nothing yesterday. 22 handles for the people that made fun of just 5 handles. It's 87 ticks per contract. So how do I know it's going to stay open? Just like a burnout. Okay, think about that funny car, that stock car that's real fast. And when that green light go, it takes off. It's going up the road. It's gone. You don't want to see it go back to the starting line. You don't want to see it do that. You want to see it what? Just keep on hauling ass. So when you're expecting price to deliver and run towards a goal and you have a limited time, what would that look like? Well, if you're trading in the 10 o'clock hour, 10 o'clock to 10:30, remember, 11 to noon is when things start creating the consolidation for lunch. Not that it will, but my expectation is things start to slow down going into lunch. And then lunch usually has a retracement, goes for the liquidity, during that hour or prior to it. And then it's either going to continue or reverse or stay consolidation. And that's a discussion entirely for 2023, because we will talk about that. But when I look at the market and I'm expecting fair value gap to stay open, I'm anticipating more volatility and velocity in the direction of that run. And see, the things that I saw with Chris Laurie's stuff, he never had that, never talked about that. Nobody else has ever talked about it either. I wish there was other books or authors and things that would talk about these things, because I could save myself a lot of aggravation, because I know it's going to take lecture and lecture and lecture doing this and also show it to you live. I have no problem doing that. But most of you that keep asking the same questions, even when I give you what I believe is the best I can articulate, it's frustrating for me because you're not going to connect with it because you haven't done other things. And for folks that have been with me for a while, the analogy of a burnout, okay, when the car takes off and skids its wheels as it's going real fast forward, that run up that creates that big candle one way, that's like that. Like that, it's a car that's just finally been allowed to go quick and it peels off real quick. Those instances when you're expecting the market to run hard, you want to see that stay open. Now, the question is going to be is, okay, well, ICT, have you ever had that instance where you felt it was likely to do that and it went back into it? Yes. If it does, I'm going to buy it. In fact, if you watch the video, I'm waiting because there was one time where I thought it was going to dip in there, and then that would have been institutional order flow entry drill. Doesn't change the bias. It doesn't change the fact that it's not going to go higher. It's going to go higher. It's just giving me an opportunity to buy it at a slightly lower discount. But in my logic is it will stay open. It will not completely close. It might go down just below the top of the fair value gap. That's institutional order flow, entry drill. It's a technique for high frequency trading. Algorithms use that as an entry model. Boom, 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 firing in there real quick. That's the other algorithm. The algorithm that is the price engine that makes price go where it's going to go and no buying and selling pressures doing anything about it, nothing. How many contracts cause the S&P to move 5 handles? How many contracts does it take to do that? Think about that logic for a second. How many contracts, how much volume does it take to move the S&P 5 handles? Oh, shit. Never thought about things like that, did you? But the books don't talk about it either, so it's never come up in question, right? You only need one contract to book price. One contract, one contract, one contract. It does not matter. That's why when you see charts that used to track volume when we were a futures trader, market keeps going up. The volume bars keep going down. What the hell's going on? Volume ain't it, folks. That's not how you use volume. That's not how you use volume. You use volume in the sense that, hey, order flow is going to increase. The velocity of orders coming in and traders wanting to do something, you can time that. You can time it. Certain times of the day, it's like, well, you know, at the opening, there's a lot of volatility, right? And that last 20-minute period of the last hour trading, you can plan on it again. So if you have untapped liquidity pools that are just so obvious, you're sitting right there, you know, that last 20 minutes of trading, that's how you do it. You aim for that. Now, what happens if you get it wrong, if it doesn't move in your favor and it stops you out or it doesn't move? That's trading, folks. That's just the way it is. You have to have a catalyst for why you're going to go into the marketplace and do whatever it is you're trying to do. If you're going to be a buyer, what makes that or constitutes a reason for you to be a buyer? There has to be some kind of logic that you're following behind you're exercising and inviting risk. You can't just, well, I feel like doing something because I got time. There has to be a logic as to why you're expecting it to do it. So, in short answer, when I'm anticipating gaps to stay open, I have already framed out the logic that it should be a market that should be moving quick. And if I see that, then I know I can do what? I can trust that my liquidity or inefficiency I'm aiming for will be traded to. That's why you see the confidence in my texts that people think it's cherry picked or that I'm adding it after the video's been done. There's no way you can explain all that shit. Okay. It's being typed through TradingView, real time. And when I type this stuff, if it was something added on after the fact, because I can take annotations and type it into a video on Camtasia. But when I add it to that, like for instance, look at my watermark, innercircletrader.com. Okay. That stays in one place. That's how you know it's Camtasia. That's added after the fact. That's an after recording annotation. In TradingView, do this and test it for yourself on Tuesday when the markets are open again. Go in there and type out something with TradingView on a 1-minute chart and then watch it. The annotations tick to the left when there's a new candle opening up. You're telling me that I have that much editing ability that I can go in there and I can fucking make 20 different things on my annotations all move in synchronicity? The fuck out of here, man. You're giving me way too much fucking credit for shit that ain't impossible. Just accept the fact that I can do this and you're going to see me do it anyway. You're going to be able to learn how to do this. Okay. Stop making excuses for holding on to dumb shit that doesn't work well for you. Okay. Or maybe you're struggling or you got to worship your hero or he's going to kick you out of your service or whatever. Fuck it. Get away from those type of people. If somebody's telling you, you better rep me in my community or you're getting kicked out of here, get the fuck away from that person. That's not a mentor. That's a nut job. Okay. You don't have to pay anything to be here. I have people in my mentorship that don't like my personality. I'm not kicking them out. They don't have to like me. I don't give a shit. You don't have to like me. I'm not here for friends. I'm not here for friends. I'm not inviting any of you over to my house. I'm not going to have dinner with you. Okay. None of that shit's going to happen. But I love turning average people into dynamos. I've done it before. And in 2023, I'm going to do a whole lot more of it. All these things repeat in the marketplace. They repeat at specific times, under specific conditions and circumstances. The job that you have is understanding which one of these things resonates with you. Some of you might look at the opening at 9:30 in the morning when equities open up. You know, when the bell stock market ding 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 opens. That volatility might scare you, might be real terrifying for some of you. And I get it, that's fine. It's kind of like London Open on a high impact news driver on Forex. You know, it's scary. How do you sell short? No one, how do you know when it's going to go? You put a stop loss in the event that you're wrong. You have to trust the logic that you're working with. See, when you read folks that are sending me tweets, and you probably see it with other people too, they'll say, you know, how do you know to put your stop loss there? How do you know when to buy that when it's going down? How do you know it's not going to keep going lower? Well, if I knew for a surety that it wasn't likely to go beyond my actual entry point, I would never use a stop loss, would I? But because, listen to this, folks, this is the cream of the crop type of advice. This is the shit that you need to write down and make sure you understand it. I know the playbooks. I know the algorithm. I know the macros. I know what it's going to do. I know when it's likely to do it. But here's what happens sometimes. I almost said his name. A particular person says, well, you know what? We want to put a little bit more oomph in this move. Or it would be more advantageous for us if it went well beyond the scope of the average daily range that everybody would expect in the opposite direction. And that's manual intervention. So when manual intervention occurs, it's much like CPI or FOMC. Shit just comes out of nowhere. You can get wrecked by it. And sometimes it just keeps on going and going and going. And you can physically be harmed beyond repair in those types of moves if you're trading size. So it's like the roulette table at the casino. Everybody thinks, well, you know, you can go over there and you can bet on red or you can bet on black. All you got to do is pick red or black. Wrong. Wrong. Because there's a green. Green is the fuck you color. Okay. You might have odds that red is going to come up. You might have odds that black's going to come up. But that table in that casino is rigged. Just like the old riverboat casinos. Okay. A lot of people don't know this, but those riverboat casinos, their roulette tables, they discovered underneath the wooden roulette wheel, there was these little metal paddles. Okay, and the operator of the table would have a paddle for red, a paddle for green, and a paddle for black. Okay, and people get in there and they bet their favorite number, their birthday, the day they got married, the day they had their kid, you know, whatever it is, they think that there's something special about it. There's a red 17, there's a black 17, whatever it is. They don't give a fuck about the number. They can't control the number. The number is not ever going to be controlled. That never, ever happens. The color is it. What happens is they say, okay, no more bets. And he waves his hand out there. Why is he doing that? Because he needs time to get an assessment on where the money is mostly. Is it more on red, more on black? And if he can't decipher right away what it is, he's pushing the green paddle. What does that mean? Underneath the wooden wheel, underneath every single one of those little squares that's either colored 17 or 12 or whatever, it's red or black or green comes up. Okay. The casino's in business to take money in, but they have to pay out. But they have to do it on a ratio basis. So when the money is being brought in, there has to be the majority for them coming in, and they pay out the minimum. Payout minimum, intake is larger. Over the course of a day, a month, a year, they profit, and people still make money. So the theory is this. If you were going back in time and you were on this riverboat, you could sit there and watch the guy say, okay, no more bets. Look at the stacks of chips on what color. Fuck the numbers. The numbers are the red herring. That's the magician's misdirection. You watch the color. Wherever the bulk of that color is being bet on, that's the fucking color that's not coming up. Now, underneath the wheel, the paddles would come up with magnets. Inside that little white ball, that ball is a magnet. It's polarized. So if that ball is bouncing around like it does, It's only going to settle on a square that will allow it to fall in. Think about how magnets, opposite attract, same repel. So if the operator doesn't want that ball to fall in a red, then it's going to be the same polarity as the ball. So when it falls in there, it'll fall and bounce out and then fall into the nearest black. Who gives a fuck what number it is? It's falling in black. So red loses. So the table collects the payout to them as income with all the bets on red, and black wins. Who gives a shit? The payout's larger for the table coming in on red than the payout on black. The black, yeah, we won. Everybody's like, fuck yeah, this guy's hot. I'm putting my money behind him. So now the table's going to watch everybody's bet based on this dude. And if he doesn't have enough time to assess how much money is in there, which is better, green's coming up and they all lose. It's all rigged, folks. It's all rigged, okay? And this is the way it is. So those one-armed bandits, those slot machines, couldn't remember what they were a couple spaces back. I don't go to casinos, but they're the same way. They're only going to pay out once they take in so much money. That's it. That's why everybody goes around, they walk around the machines and they say, okay, I'm watching this person. He's been here for 4 hours. Okay, it ain't hit for a while. If they get up and get on that machine. Not because you are lucky, they know what? It's going to pay out. It's due to pay out. Now, take that same logic and apply it to time of day of week, report days, medium impact, high impact, liquidity, and it all makes sense. There's controllers in everything that we do. You go to work, you got a boss. You're going to put your money in the marketplace? There's a boss. That boss has a job. Manipulate the money from your hands into theirs. Oh, now you're going back on saying the brokers are trading against the client. I'm not even talking about the broker. I'm talking about an entirely different entity way above them. That's that collective entity that is smart money. That's who's working in all these things. This opportunity, this whole facade, thinking that you have a free and random market when that is not the case at all. How the fuck can I do what I'm doing if it's random? How can it be that precise if it's random? If there's no algorithm, how can I display, teach, and repeat over and over and over again? Here's my challenge to the naysayers. I want you to outline a market like I did on Friday. One-sided, very specific level, and then record precision entries, mark up the annotations, everything, record it. I don't need you to do it live. Record it through TradingView, because I know it can't happen through Market Replay. And then you post that and say, this is how ICT is doing it. It's cherry picked. You can't, because if you're managing a 1 minute chart, how many 1 minute charts can you manage another 1 minute chart going the opposite direction when you're managing that 1 minute chart, annotating it, constantly moving everything? Look, man, that's some bullshit. Okay, that's some bullshit. And takeaway is this: it was already talked about hours before in the morning session. There's no way you can argue against it. And I can do it live in any setting. Hello. So there probably isn't going to ever be another mentor like me. I'm a little unstable and probably lunatic fringe in most of your minds, and that's fine. that gets me. It makes me a little bit more interesting than the average person. But I use that like a carnival barker, just like I use the demo baller. Oh, let's just see this clown. What the hell? This guy keeps calling it right. Yeah. Yep. And I'm hiding in plain sight. Who's going to take a demo baller serious? Nobody. But anybody that's ever came to my mentorship, they only saw demo trades. They only saw me executing just like this shit all the time. There was any other imitation except for seeing what you've been watching me do. And now you're all going to get a taste of learning just how to do it for free and real time. It's exciting, isn't it? If you're not excited, if you're not all amped up about, broadening your understanding about price action, and I don't know what to tell you, because it's going to be fun. It's going to be real fun.